Okay, good day and welcome to our Friday class. Please note that the class is now being recorded as I speak. We are going to start with our lesson, which is financial statement analysis. So we are continuing with chapter 4, interpreting financial results. Today we'll be doing analysis and interpretation of part A, which is lesson number 19. So as I did indicate earlier on that we'll start by actually doing the activity that I asked you as a homework. So I'm going to request that homework next week, Tuesday. So please make sure that you still have it and you bring it to class on next week, Tuesday. Since majority of students did not show up currently, we're just going to focus on the current lesson, which is lesson number 19. So we'll be covering page 207 to 208. There is a YouTube link on the recording that you can actually use as part of actually trying to understand or gaining more insight in terms of analyzing financial statement and who gets to perform to analyze financial statements. So what to do, as you are aware, it is very that much important that you attend all your classes regularly, especially during this period where we are going towards or we're working towards the summative assessment. Most of the topics here are going to be challenging as the more we gradually do them. So please make sure that you get to attend your classes regularly. Do the class activity as requested to gain more understanding, and then also consult if you feel like you are a bit lost. So the learning outcome for today's lesson is that you need to understand financial statement. That's the first thing. Explain the different uses of financial statements, types of financial statement analysis that can actually be performed, and the limitation of using financial ratios as a measure of analyzing financial statement. Discuss the requirement for financial ratios, as well as lastly to calculate and interpret financial ratios. So when a company operates in a public space and it is listed within the public space, it is required by law to actually disclose its financial statement to show that if its financial statement have been fairly prepared and its operation and everything that of its operation, how much it have made, as part of showing its fair presentation of the data that it has as well as its operation. So it's part of a requirement for any public trading company that is listed and required by law to do so. So they provide what we call an annual report at the end of each and every financial year. So an annual report includes the summary of the executive of what the company have been doing and what it have managed to achieve and what are the plan of the companies in the future. It also includes an audit report in terms of whether the company's financial statement have been fairly presented according to the way in which the company was operating and how the company generated revenue was in good order, didn't break any laws and all of that. So all of that will also be presented within the annual report. Another thing that will also be provided in the annual report will actually be the financial statements of the company. So the financial statement of the company include your statement of financial position, statement of comprehensive income, and statement of cash flow. So all of these statements will be presented within an annual report of the company. So the main aim of providing this is to actually provide analysts with information as well as the public with information about the company's financial health. So here it says that it indicates the financial performance position of the company for analysis and comparison. So this financial statement allows us to be able to compare and as well to understand the company's financial health and its position in terms of usage or in terms of the way in which its capital structure is structured. So capital structure refers to a method or refer to a practice that a company chooses in terms of how they finance their assets. So a company can choose to use 40% of debt, 60% of equity, meaning that they are going to raise whatever money they need, they're going to borrow 40% of it, and then 60% of it, they're going to sell some of their shares to actually raise that money. So that will be the capital structure of the company. So it actually tells us more about the financial position of the company. And in terms of performance, we get to look at the statement of comprehensive income, which is the income statement, to assess if this company has been doing well and what is its status in terms of this current financial period operations. So the main objective of the financial statement is to provide a summary of financial position, a summary of financial performance, a summary of change in financial position. So when we talk about financial position, we are talking about your balance sheet statement where you've got your assets, your owner's equity and liabilities. So all of those form part of the statement of financial position, or it gives us a summary to say that this company currently have got 40 million debt and 60 million equity. So in total, the company assets are worth 100 million. So 60% of these assets are financed by the money that was raised by equity, and then 40% is financed by money that was raised through debt. So that's the financial position of the company. So it have got less debt within its financial structure. And then in terms of performance, it tells us the summary, it's all about whether the company managed to generate profit and did the strategy of the company pay off. So looking in terms of the position, the company have got enough assets and have got positive assets. And with these assets, the company is able to utilize them to generate returns for the investors, which we look at the financial performance, which is the income statement. Changes in financial position as well. The changes in financial position is similar to financial performance, which is the income statement. It only shows us detail for one financial period, to say that from this financial period, from the last to the current, these have been the changes in the financial position. This is how much cash went in, this is how much cash went out, and therefore at the end, this is how much cash was left available during this financial period. So it indicates how we changed from last year's financial position to this year's position. For example, the company can buy back 40% of its shares, and then after that goes and borrow 20 million again. So this means that now the debt will be 60,000 and the equity will be 40. So meaning that more of the company assets are actually bought or financed through equity, through debt than the shares, because the company have bought back some shares. So here on the changes in financial position, we will have three items, which is investments. We'll have investment operating activities. So we're going to have operating activities. After operating, we're going to have investment activities. We're going to have financing activities. So financing, we'll talk about how the company, whether the company is still paying, how much is it paying for as a return to the investors, how much did it raise back in terms of, did it buy back the shares or did it sell or go and borrow more money? Investing, what did the company invest on? Are they new assets or did we sell any old assets? Operating activities, we'll talk about how much money was made from operating activities by selling our products, and then how much was actually made from what was the change in working capital, which is the movement of our inventory, movement of our customers. So all of those are assessed within the change in financial position. So it assesses every movement that happened here from whatever position that we were from, and any changes will actually be reflected here to say that here we've got a positive change, more money came in from operating activity. Here we've got a positive, more assets were actually sold. And then here we've got a minus, so meaning that we've actually went and bought on pay more money from our debt that we actually have. So this means that at the end, plus, depending on the amount, will give us a final figure, whether it is positive or negative, depending on which figures are big. So that's the changes in financial position. So that is the main objective of these financial statements, to give us an insight of the health of the company. So in terms of financial position, it is influenced by the capital structure. As I mentioned, the capital structure, it's either debt or equity. So we only talk about these two type of sources of capital. How did we actually raise capital? And therefore, this will therefore be used to finance the assets. The resources refer to assets of the company. And then this is evaluated by focusing on assets, liabilities, and shareholders' equity in the statement of financial position, which is the balance sheet, to assess if the company's standing is still in good shape. The company does not have too much debt compared to its equity. And then in terms of financial performance, the objective is that it allows us to be able to see if the company is able to generate income with its available assets. And we also evaluate this by focusing on the revenue generate and the expenses that help the company or that contributed to this revenue generation. So we assess if the company is profitable enough. Change in financial performance. So here I did mention that we focus on the operating activity, financing and investing activity during the year. How much money went out, how much money went in, how much money was raised through finance, how much money was paid back to the finance, to the capital provider. Investment, what did we invest in? Did we buy new assets? Did we sell old assets? So that's what we get to assess. So the statement of cash flow provides the summary of this activity, which is the change in financial position from where we were to where we are actually going. Unfortunately, I don't have my other device next to me. So this means that I won't be able to see if you guys are following or have any question. So what I'm going to do is that I'm just going to switch back and forth from the screen of from the screen of Teams and then back to the PowerPoint presentation so that I can ask you guys some few questions if you are actually following up or if you have got any question. But if you have got some question, please feel free to just send a message on the chat section or stop me as we continue and ask me a question, since sometimes I won't be able to see you at the same moment that you raised your hand. So just to quickly confirm, are you guys still with me? Just a quick confirmation. Are you guys still with me? Tulugelo and Manda, are you still with me? Okay, thank you very much for the confirmation, and thank you, Kamo, for joining us. So we are still busy with the introduction of financial statement analysis. So this then brings us to the user of financial statement. So financial statement have got different number of users and they use for different purpose. So the users of financial statement are also known as the stakeholders, people who have got stake over the business operation, who have got interest in what the business does. So we start with the shareholders of the company. So shareholders are the guys that actually have share of the business. There are the other partners of the business, or there are people who bought shares or invest into the company's shares and who owns over 15% of company shares up to even 100%. So those are what we call the shareholders. So these guys, they require financial statement to evaluate existing and expected performance, to say this is what we expect this year in terms of performance and what we expect as a return in terms of the dividends. What they need as dividends is return over the investment, to say that we invest this. We expect the company to perform in such a way because we invested a lot of money that allows the company to enter into new project or acquire new project or acquire new machines that can be used in production or that can be used to render services and give us better returns. And then for management of the company, unfortunately I can't see my cursor anymore. Okay, it is. Sorry about this. I am busy exporting some file. So there is a chance that my laptop might run a bit slow in terms of memory, and therefore I won't be able to move smoothly with you guys because of that. There is a recording that I just did not so long ago using PowerPoint, and I am busy exporting it, so it might actually have some effects over my presentation over here. So I'm gonna try and use so I'm gonna use my mouse over this side to actually point out the information that I'm busy working on or explaining about, so that because the pen will actually make things slower. So I was now moving to management of the company. So management of the company, they use financial statement for planning and controlling to see if their plan actually is working or it's not working, and if their plan is not working, what control measure can they actually take, or what ways can they actually mitigate the risk and go back or revert back to finding ways in which they can eliminate the risk or get back on track with their strategy that will actually pay off and allow the shareholders to earn much better returns over their investment. Other users of financial statement includes the debt capital providers. These include individuals who invest in company bonds or people who actually loan the company's money. So these guys will evaluate the capital structure of the company, which is from the statement of financial position, which gives us indication of how much debt was used compared to equity, and therefore the ability to pay interest rate, which will therefore be assessed through the income statement, how much profit was made and how much of that profit can be able to pay interest rate, or it can be able to pay the installment that will require from these guys if we were to give them a loan. So debt providers, they are also users of financial statement. They use it in that way. Government also use your financial statements or the company financial statement to assess how much is due to them, which is therefore the South African Revenue Collection Service, SARS. They get to use that to actually get to assess how much you owe them and how much do they owe you based on the income you have made and how much you have paid them so far. Economical statistician, they also get to use your financial statement or company financial statement to predict future results as well as performance of the economy, looking at way in which the companies are operating in this country by looking at their financial statement and see if they're struggling or they're doing much better. Other stakeholders include employees. Employees and the union actually use the financial statement to use it to bargain for their salaries increase. And then clients who are interested in the business would like to see if the business that they actually support will actually continue to exist in the next coming few years. And so those are the clients, they will actually get to evaluate the project or the company's financial statement. Customers as well, they will do the same as the clients. Suppliers, they will use the financial statement to see if they can actually offer credit to this company and sell their product to this company on a credit basis if the company is making enough money and they don't have too much debt already in their books. And then competitors as well to see the competitive advantage, how much did this guy make in profit in excess of what we actually made. So this is something that will be assessed through by the users of financial statements. So we've got a lot of use of financial statement, but they're not limited to this one shown here. We still have got more users that are also not listed here, but these are the most common users of financial statements. So the requirement of preparation of financial statement is that when financial statements are presented, you need to make sure that they are understandable. That is why all financial statements I explain in class that your income statement will never change no matter what or what year level you are studying the income statement from. It will remain the same, and for each and every company, they will be required to present their income statement using the same format because it needs to be understandable to each and every individual reading the income statement. Relevant, all information that is presented, we need to make sure that It speaks to the timeline in the year in which it was presented, and it is significant based on what that company is actually doing during that particular period. Because this information, if it's not relevant, therefore it means that you won't be able to use it for decision making. So its relevance is important because of decision making. So therefore, we need to make sure that these financial statements are prepared and information is 100% relevant so that we can be able to make decision. Also, financial statement needs to be accurate and objective. So they need to have a purpose to say that this is what we actually managed to achieve this year. So they need to be accurate in terms of financial figures. And also, there is a standard that gets to be used. So all financial statements needs to be comparable. So according to the International Financial Reporting Standard, known as the IFRS, it is the one that determines the format in which all financial statements needs to be presented. So those are the requirements for financial statement, and these are the users of financial statements. Before we move forward, any question from you guys? Any question? Tologelo and Manda, do you have any question? No questions from Manda. Okay, since there is nothing on Tologelo, thank you for the thumbs up. So this now brings us to the format of the statement of financial position. So statement of financial position is made out of your current assets plus your current liabilities, which all of these will be equal to the following things, which are your ordinary shares. Reserve are actually the company. So I'll just try and explain a bit about reserves. So reserve, these are what we call share buyback. This is when the company owns itself. So the company will sell shares and then ordinary people will buy them and therefore they become ordinary shareholders. Then when the company or when the shareholders decide they no longer want to become part of the company, when they sell the shares, company will buy back the shares. So we call this share buyback. So it forms part of what we call reserves. So reserves, it include shares that have been bought back by the company. So meaning that the company is avoiding to lose control over itself by giving too much control to shareholders. So they buy back some shares, and those shares are classified as reserves. So if the company wants to raise money in the future, they can sell those shares that they actually own instead of the new ones, and therefore make money and be able to finance any project they want to take. And then part of this, some other include retained earnings within reserve, which is the profit that the company didn't share with the shareholders. So it's part that is profit that is remaining. So that's other companies, but this can also be treated separately from reserve and have its own line item called retained earning. And then you have got your preference shares, non-controlling interest when company A owns company B. So meaning that, let's say this is for company A, and then we've got company B. Company A owns 80% of company B. So it does not own 20%, complete 100%. There is 20% it doesn't own. That 20% it does not own will be represented here in value to say that how much of that assets, how much is the 20% of company B that we do not own. We call those non-controlling interests. Those are the interests we don't control over that business. And then current liabilities, non-current liabilities. So all of these things on this side are supposed to equal to your current assets and current non-current assets, because current assets and non-current assets are financed by all the money that was raised over here on this right-hand side. On the right-hand side, it's the way in which we raise money to finance the left-hand side. So meaning that whatever money we receive, we're supposed to equal whatever money we spend on the assets. So your current assets and current non-current assets supposed to equal your ordinary share, reserve, plus preference shares, plus non-controlling interest, plus current liabilities plus non-current liabilities. On the income statement, your income should be equal to all the expenses that you incurred and the profit. If you want to calculate profit, that will be the income minus the expenses, then it will give you profit. Your profit plus expense equals to your income. And then this brings us now to the main concept of today, which is ratio analysis for financial statement. So part that is missing here is talking about, I'm not sure if it's missing. I just want to check. I think it is missing different types of financial statement analysis. So financial statement analysis, we can actually do trend analysis. We analyze trend of the financial statements. How do they go up? When do they go up? What causes them to go up? So that's a trend analysis. And then we also have got ratio analysis. And then we've got assets analysis. Asset analysis will analyze the company based on its assets, market value, book value. So those are the type of analysis we get to perform. So there are types of analysis that can be performed, but the most commonly used type of the type of analysis that we normally get to use most of the time is known as the ratio analysis. So it's one of the most common analysis that gets to be performed on financial statement. So here it says that information provided in financial statement is used to calculate financial ratios. So financial ratios are those indication or the attempt to provide more details about the company performance, to say that if this is the financial statement of the company and the ratio it's saying 20%, this 20% explain or it gives us more meaning than just looking at the figures of the company to say that the company made a profit of 200,000 and their revenue was 800,000 or their sales was 800. This is their profit at the end. So therefore profit at the end, net profit margin is 20%. So it just indicates how much profit did we generate on top of from the total revenue that we generated. So we only managed to only share 20% as our profit. So here it says that understandable than the financial figures in the financials. And there are meaningful relationship between items from financial statement, which are only investigated through ratios. So we get to assess how much did our expenses contribute towards revenue generation, which we go and say operating expense over sales. This will actually give us a percentage to say that from the total sales of 800,000, if our expense are 200,000, therefore 23 or 24% of our revenue is explained by our expenses. So meaning that for us to generate the 800K revenue, it means that 28% of it comes from operating expenses that we incurred. If without those expenses, we'll have lost 20% of that revenue because we'll never be able to generate it. So that's part of ratio analysis. So the requirement for financial ratio analysis is that the premise that it's simply to evaluate the financial performance and position of the company. The ratio needs to be meaningful, meaning that the logical comparison between items from financial statement needs to be valid. For example, the gross profit margin ratio. So with the gross profit margin ratio, this ratio needs to be meaningful. We need to be able to understand what are we actually calculating. So I cannot go and say cost of sales ratio, where I'm going to say cost of sales over sales. This ratio will not be much meaningful, but the only way for this to be meaningful is to use the gross profit margin over sales to assess how much did cost of sales assist us to realize profit after its contribution. So that's the easiest way. But for us to go and say cost of sales margin ratio, it will not be much meaningful. And therefore, they need to be relevant. True indication of financial information situation. When we calculate the gross profit, it will actually tell us if we incurred a higher cost of sales or a lower cost of sales. So they are relevant in terms of true indication of a financial situation, whether the company is making more money or it's incurring more money over cost of sales. Comparable. Each and every company, we can be able to calculate the gross profit margin ratio because it's just only gross profit over sales multiplied by 100%. Therefore, it will actually allows us to continue to monitor that because the company will still present its financial information in that manner. So the limitation of financial ratios. So the limitation of financial ratios are that information is based on historical information, not current information. So we based our ratios on last year's financial statements. Changes in accounting policies. So this is another limitation because currently we used to use the International Accounting Standard, and then we now adopted the International Financial Reporting. So meaning that the way in which some of the items within the financial statement are recorded will actually therefore differ from the way in which we used to record them previously. So this means that when we perform ratios, our ratio meanings, some of the ratio meanings will actually have to change, or we actually have no longer need for them to be calculated because it is no longer valid, or it will no longer have a meaning because of the change in accounting policies. Manipulation of financial statement. As we all know that financial statements are prepared by accountants, and accountants can be able to manipulate financial statement just to make sure that whoever gets to use it at that particular time, they get to use it to the benefit of the company. For example, right now, we've got this company called Canal, which is trying to buy MultiChoice. So MultiChoice can manipulate its financial statement to actually make its financial, to make its what do you call this, to make its share price go up, thinking that it's being profitable and it's having high assets value and it's generating enough return for its investors. So meaning that Canal will actually have to pay more because of that. So it's easy to manipulate financial statements if you are actually an expert in preparation of financial statement and the company's operation. So this is one of the limitations, because if financial statements are manipulated, also our financial ratio will actually result in actually giving false information or incorrect results. So meaning that the quality of data of our financial statement will also lead to the quality of data for our financial ratios. The period of analysis, which year are you actually preparing the analysis for, and which year are you actually going to use this analysis in. So this is another limitation. You cannot prepare an analysis of financial statement using ratio during COVID period and want to use it now for this period, because during COVID period there was a crisis, and during that crisis different companies were affected by the crisis in different ways, and therefore, which means that whatever was affecting the company during that particular period have passed with the storm, and now the company is faced with new challenges as well. This means that you need to analyze the company during this particular period for you to be able to make decision on whether to invest or not based on the COVID period. Unless there is another crisis coming in, then you can be able to use the old data period and then analyze and therefore predict what might actually happen in the future. The financial statements are actually summarized data. They do not tell us everything about what happened during the year. As we did notice during our first term, that when we prepare financial statements, a transaction will occur, everything will be recorded in the accounting equation, from accounting equation to your ledger account, from your ledger account to the trial balance. At the end of the day, our financial statement just only shows the balance of that particular account. to say that this account have got a balance of 400,000, 200,000. It does not give us any details of how that 400,000 came into existence. So that's another limitation that it also gives to the financial ratios, because financial ratios are using summarized data that does not give much details in terms of what happened during the year in that company. And then this now brings us to types of ratios. Before I do types of ratios, do you guys have got any questions? Any question, guys? Yes, Manda?
Are these notes going to be on GoCampus?
The notes are already on GoCampus. Each and every week before we start with the week, the academic manager upload all of this before we start the week.
Okay.
Yes.
Thank you.
All right. Hello, any question or you are good? All right. Just give me just 1 minute just to help myself out, and then we can be able to continue. This time around, we're going to be talking about types of ratios and how to calculate them, and what does each and every ratio actually means, and what could be the possibility for a low ratio or a high ratio that we are trying to calculate. So just a moment, and then we can continue. I am actually back, guys. Let's continue. So here we'll be talking about types of ratios that are used to evaluate. So we're not going to focus on all. There are a number of ratios that we normally do. So we've got profitability ratios, we've got liquidity ratios, we've got solvency ratios, we've got investment ratios, we've got cash flow ratios, we've got turnover ratios. So I think in total we've got somewhere around 7 categories to 8 categories of ratios. But for our learning purpose, we're going to focus on the major types of ratios, which are actually useful for a company and for internal purpose as well for external purpose. Profitability ratios, these are the type of ratios that actually measures how efficient is the company using its assets to generate returns. So here we assess the profitability of the company, the operation of the company, if the strategy is actually paying off. So we assess this through profitability. And then the liquidity ratios. Liquidity refers to the ability of the company to meet its short-term obligation. So here on the liquidity ratio, we'll be assessing the ways in which to assess whether the company is utilizing its resources very well to be able to always have availability of cash in hand, and also not to have its debt in excess of its assets. So those are what we'll be assessing in terms of the liquidity ratios. So in terms of profitability ratios, today we're going to be focusing on the profitability ratios, starting with the gross profit ratio. So the gross profit ratios, it measures in percentage net profit ratio percentage and the return on average owner's equity will also be measured in percentage. And then on this one over this side, they are not measured in percentage, but they are measured in a fraction ratio. So the current ratio is measured in a fraction, acid test in a fraction, average trade receivable collection period is measured in days, average trade payable collection period is measured in days, average inventory turnover time ratio is measured in time, and then we also have got another one called inventory holding period, which is therefore measured in days as well. But this time around we're looking at focusing on the one that is measured in times, which is the inventory turnover time. So let's take a look at the profitability ratios one by one. So the gross profit margin. So here it says that the gross profit margin is a portion of total sales that is realized as gross profit after cost of sales has been subtracted. So it actually tells us how much profit have been realized after the contribution by cost of sales. To say that profit, to say that revenue, it's either we call it revenue or we just call this sales. Sales is always 100%. Then cost of sales, cost of sales is a contribution expense that allows us to generate this revenue of 100%. So once it is subtracted, therefore we will be left with gross profit, which can therefore be 40%. So meaning that cost of sales contributed 60% in generating the revenue. So therefore whatever will be remaining with will be actually the gross profit. So this can be measured in percentage format. So instead of doing or calculating the cost of sales contribution, we calculate the gross profit margin. So the gross profit margin will actually be the profit realized after contribution by cost of sales. So the gross profit ratio, it's a financial ratios that measure performance and efficiency of the business by dividing its gross profit figure by the total net sales. And if you still remember the net sales, on our last video we said that net sales it's equals to sales minus discount granted to customers, and then again minus sales return. So all of this will give you your net sales at the end of the day. So if the company's core activity is to sell product and render services, so the net sales will also include plus services rendered income. So in case if the company also renders services part of its core business activities. So gross profit is your gross profit over total sales multiplied by 100. So in most cases this will not happen. So it will just be your sales discount and sales return. So therefore gross profit will equal to gross profit over total sales multiplied by 100. The final answer will actually be in percentage format. All profitability ratios, when you calculate at the end, they'll be in percentage format. So let's assume that it gives us 40%. So 40%, it means that after contribution of cost of sales, the company have managed to realize a profit of 40% on the revenue or sales that it have generated. So meaning that out of 100% revenue generated, 40% of it is realized after the contribution of cost of sales. And therefore, let's assume that the industry in which the business operates in says that the average is 35%. This means that this company is generating more gross profit than what the industry is generating. So this could just only mean that the company is actually buying its supplier or its inventory at a lower cost, because the cost of sales will be much lesser than the industry to allow it to have a higher gross profit. If the company cost of sales is much higher, therefore it means that lesser gross profit will be realized, and therefore it will be lesser than the industry. This means that we'll be incurring more cost in terms of acquiring our inventory, which therefore turns into cost of sales. So you can just note this down or you'll refer back to the recording and note it down to say that if cost of sales, if gross profit is higher than the industry, it means that the company is buying cheaper resources, or it's actually having a low production cost. This means that its cost of sales is much lesser compared to the industry's average, and therefore higher gross profit margin will be realized by the company. So that's how you can actually comment in terms of having a gross profit that is more bigger than the industry.
Sir?
Yes?
What if the product you're selling is like better than all the other ones in the other industries?
So
And
your
it's in demand.
So your comment will be that the company is selling a superior product than the competitors.
Yes.
That's why its gross profit is higher than the industry.
Yes.
Yeah, so your comment is to say the product offered by the company is superior to the rival or to the competitors.
But it's
So,
somewhat the same price as the other competitors.
Sorry?
It's somewhat the same price as the products that the other competitors are selling.
So what if the prices are the same?
Yeah.
So if the prices are the same, mostly we will be speaking about the quality.
Yeah.
So meaning that in terms of comment, you'll be saying that the product offered by our company, it's of high quality that relates to us having to sell more product and realize more revenue.
Yeah.
Yeah, so, sorry?
Okay, yeah, no, I get you.
All right, and let's see, you're still there, Tulogelo, are you following? Right, thank you for the confirmation. So this is how you get to comment, and this is how mostly the most important thing about calculating these ratios. If you go back to the previous slide, we talked about being comparable. So when we talk about comparable, we'll now talk about the commenting part. That's the most important thing. How do you know your company is actually doing better, and how do you explain that it is actually doing better? Because if someone says that this is your company, this is the industry's average, then how do you explain this? So this is the most important part.
Sir?
Yes?
Is it possible that like in the test, we'll get a question that has a total gross profit that's in the negative?
That's completely impossible.
Okay.
So what normally happens is that gross profit in all cases is normally positive. The only thing that will be negative might be your net profit at the end of the year.
Okay, I hear you.
Yes, because gross profit is at the top part of your income statement. Not all expenses have yet been realized or taken account into. Once you have taken all the account of all the expenses, you might find that then your net profit goes into a negative, and then you have a net loss.
Oh, okay, I see.
Yes, so but the gross profit always positive at all cost, at all time.
Okay.
So then this brings us to the net profit. So the net profit, it is the total profit available after sales and after tax is paid, or after all the expenses are paid. So when you calculate the net profit margin, the net profit margin is the profit that is realized after all the expenses have been taken into account for. So here it says that the net profit margin is simply the net margin. It measures how much net income of profit is generated as a percentage of revenue, which is also known as sales. It is the ratio on net profit to revenue for a company or a business segment. So indication of portion of turnover that belongs to the shareholders or the owners of the business. So here we're calculating the portion of the total revenue that we generate, how much of it is actually profit after all the contribution by all the expenses, and therefore this then belongs to as well to our shareholders because all expenses have been paid. Now the only thing that is left is for us to declare dividends on this profit or give it all to the shareholders as their return over their investments. So the net profit can therefore be a negative. This one is the one that can be negative because the company can generate a revenue of 100%. In example, I'll just say 600,000. And then cost of sales, so I'll say this is sales. And then cost of sales, I'll say that it's 60%. Therefore, gross profit will actually be 40%. So this side, I'm not sure how much the figure will look like. So here, let me just say 100,000 to make this more realistic and easy to do. And therefore here we'll therefore have 40,000 as gross profit, and then as a percentage will actually be 40%. And then here you then have your operating expenses. Your operating expenses. With the operating expenses, you find that your operating expenses are actually 50,000. This means that you then run at a loss of 10,000 because you spent more money trying to generate this revenue, and then already including on top of your cost of sales, you spend it 50,000. So you only managed to generate a revenue of 100,000. So which means that here your contributing expenses are actually 50%. So this means that your net profit becomes minus 10%. So this is where you get to receive a negative in terms of the calculations. So when you calculate your net profit over total sales, it will be 10 out of 100, which will still give you 10%, negative 10%, because this is negative, and therefore you still get to receive the same. So it's 10,000, which is negative, over 100,000, which is your sales. Sorry about this, guys. My laptop just did it again due to this PowerPoint that I'm still exporting into a video. So I was still explaining this part, that is your net profit of minus 10,000 divided by a total sales of 100,000 multiplied by 100. This will give you a minus 10% net profit. So this just indicates that the total expenses that the company incurred are in excess of the revenue that have been generated. So your expenses contributed more than what you actually generated. So which means that the strategy that the company decided to use did not manage to pay off. So this means that if I was an investor, I would want to invest in this company because the investors of these companies are now having a loss to share, which is minus 10,000, because net profit is the money that is remaining for the investors. So therefore, I will not want to choose this company to invest into. And this just also means that the strategy did not pay off that they actually took as a company. So what could be the possibility of this being a negative? Company is having too much operating expenses in most cases, because the gross profit at all time, it's always positive. So your comment is that the company is having too much operating expenses than the industry. And if the company wants to improve, they have to cut some operating expenses or try to minimize the operating expenses cost by lowering them or finding different ways to operate as a company so that they can have lower operating cost. So the comment, if it is negative or it's lower than the industry. So let me just first erase all of these so that we can I think there is a challenge here. I kept this will no longer erased. since I kept them during that time of resetting back. So assuming that your company net profit is 20%, the industry in which it operates in, it's 15%. This just indicates that the company's operating expenses are lesser, or the company is having lesser operating expenses compared to the industry. And then if it's vice versa, it means that the company is actually having higher operating expenses than the industry. So what could be the cause? So taking a look at the company, during the scenario or based on the company profile, some company operate in a segment or in an industry that is very risky. So meaning that if the industry is very risky, we might expect them to pay a higher insurance cost. So meaning that some of the cost of this company to generate lesser return than the industry will actually be because of higher insurance cost as well as storage cost because of safety reasons. So meaning that the company will therefore have a lower net profit than the industry. In case where it's higher, this means that the company have got lesser operating cost than the industry. So this means that the company will be using different strategy or using different costing system that allows them to have a lesser operating expenses or production costs for them to be able to realize higher profit margins. So that's the comment in terms of the net profit margin. And then this brings us to the last profitability ratio, which is actually the return on average owner's equity. So return on average owner's equity, what it does is it measures the efficiency use of the capital provided by the owners of the business. So a company sells shares and then the shareholders or the investors buys the shares and they become what we call shareholders. So when they become shareholders, they will actually need a return. So the return of that investment will be measured through how much profit is that company generating on an annual basis. So on each and every annual basis, we'll compare the profit against the capital that we invested in that company. And therefore, this will tell us how much as an investor you are going to be earning on your return. So remember, the most important thing here is that the higher your net profit margin, the higher your return on equity. This means that when the net profit margin or return on equity increase, your share price of the company also increase, because when investors or when analysts get to see that this company is generating enough profit and the investors are able to get enough returns. So this means that the share of that particular company become in demand, and when it become in demand, and it's because it's a very scarce resource, it will therefore be priced at a higher fee. And then because it's less profitable, it will therefore be priced at a lesser fee. Less people requiring to buy your shares, less pricey it will be, even though your company is doing much better. But if there are no people interested in that, there is no demand. So if there's no demand, your price will still remain on an average basis. So we still talk about the demand and supply of shares as well. So if you're more profitable, people will want to invest because they know that they're going to benefit from the demand. So they're going to benefit from the profit return that they're going to get from your company. So this means that more people will be interested. For example, the Sasol Group, I think during the COVID period, it was doing much better. And therefore, due to the demand of that, its share price went up very much. People invested into it on EasyEquity, made a lot of money through by buying the Sasol shares. It is still doing well even now, but it's still facing some challenges, because I think I read not so long ago that some of its assets were actually overvalued. It lost a value on its assets somewhere around 137 billion. So that's how much it lost in terms of valuing of assets. So meaning that some assets were not maintained very well and they've lost its value. So that also affects the share price. And while it affects the share price, it also affects, you find that if that asset was the one that was used the most and then it no longer have value, this means that the company might be forced to no longer use that asset or to utilize the assets, and therefore it won't be able to generate as much revenue as it is used to. So that might affect the profitability as well. So that will drop the price of the shares. So the return on average of owner's equity calculate how much return are the owners making based on their capital provided. So here it says that return on average is a profitability ratios that measure the amount of net income compared to the average shareholders' equity of the company. And the goal of this ratio is to estimate the performance of the company using its owners' investment to generate profit. So total owners' equity include capital and retained profit, and net profit after tax represent profit available to owners. So if industry, let's start with company. Company return on equity, I'll just say return on equity, even this return on average return on average owner's equity, I'll say that the company performed in this ratio 12%. And then industry, I'll say that the industry is saying that most people are getting, let me make it a bit bigger this time. Let me say 18%. Let's make it a bit bigger, say industry is 18%. So what this actually means is to say that the companies are not utilizing well the capital provided by the investor. So meaning that they're not investing into assets that can be able to generate enough return for the investor. So meaning that also the assets that the company have are not utilized well enough for the benefit of the investors. So that will be the comment. Because if they are utilized well enough, the company should be at least generating a return of 18% for its investors, because that's what the industry is offering. So if we're looking at a company in a media environment and say that media environment companies are generally giving return of 18%, yours is giving 12%. So this means that you are not utilizing your assets to its full capacity to be able to generate return for the investors. This means that capital provided by investors is not well invested by the management of the company. So that's why the company's return on average owner's equity is below the industry norm. So that's the explanation for bad performance. If it's good performance, it means that the assets of the company are utilized well and the capital is actually invested into assets that are actually generating enough return for the investors, and therefore management are using those assets to the fullest to be able to generate much return for the investors or for the capital providers. So that's why the company is performing better than the industry, if it was vice versa. So any question, guys, on the profitability ratios? Any question on the profitability ratios? No question on the profitability ratio. So I just want us to then take a look into an example on the textbook, example 4F. So example 4F, it requires us to calculate the below ratio, the gross profit for 2002 to 2004, net profit ratio for 2002 and 2004, and return on average owner's equity for 2002 to 2004. So I'm just going to try and switch to that and see if I have it opened here or it's not far from me. So these are, okay, here we are. So here we've got the following, which is the statement of profit and loss and other comprehensive income, which says sales less cost of sales, gross profit, we have given the value, add other income, less other expenses, net profit for the year is they are given there below, And as we continue to go down, we're given the statement of financial position, which then have our assets and our non-current assets, current liability, total assets, equity and liabilities, and owner's equities, and non-current liabilities, current liability, total equity and liabilities. And as you are aware that the statement of financial position, the assets must be equal to total equity and liability. As you can see, both here at 690, 690, 657, 657, everything must balance. If the investor gives the company 690,000, they expect that 690 to be invested in assets. So whichever the assets they invest into should be equaling the 690 that they will got from the investors. If the company makes profit, more cash will be available, and therefore we expect the owner's equity value to also goes up as well. The share price to also goes up, and therefore will go up by the same value as how much profit did the company actually make. So meaning that it will always balance at the end of the day. So you are required to prepare those three ratios. And here it also talks about the business publishes educational books, sell them at a markup of 50% on cost. 80% of sales are on credit. So this information is just indication for you to be able to comment or be able to identify what could be the cost behind increase and decrease in revenue and over the years, and what could be the possibilities. So this is the information that allows you to be able to have insight in terms of the changes of those percentage. So markup of 50%, it means that if we produce a product that costs us 100 Rand, we're going to sell it for 150, meaning that we're charging 50% markup. 50% is 50% of the cost, then we add it back. That means that that's 150. 80% of sales are on credit. It means that out of the 100% of sales that we make, 80% of it is sold to customer on credit, and then we collect later on from our customers. The risk-free interest rate on investment within the industry in which the business operates is 10%. So meaning that if we're in a media environment and we are investing into a risk-free rate, are those type of investment where you are guaranteed your money back as well as the interest that you actually supposed to receive. This is what we call a risk-free interest rate investment. So it's similar to as investing your money onto a government bond. Government is, we call them risk-free because the government is required by law that it gives you back the investment money that you invest, unlike you invest into a company and say, I'm borrowing my money to this company. If that company collapses, your money collapses with it, and therefore you'll only get whatever scrap money that they will get once they scrap every asset of that company. So those are not risk-free. Only government bonds are risk-free, and as well as investment from the bank are also risk-free. So you get to be guaranteed your capital back, but not the interest on the banks. But there are some that also offer risk-free interest, meaning that even if anything fails, you'll still receive your interest for that particular period. Assume 365 days in a year. It means that this company operates 365 days in a year. The average inventory turnover for the publishing industry has been established at around 12 times per year since 19.9. So meaning that for this industry, since it's a publishing industry, inventory, it is actually sold, or it is actually turned into sales 12 times in a year for them to generate that revenue, whatever revenue we saw up there. So it is used 12 times to generate revenue. So this is the industry. So if ours is lesser than this, then it is a problem. We expect it to be higher than the 12 times per year, meaning that we need to sell our books more than the industry itself, which is 12 times in a year. So we need to sell our inventory more than 12 times in a year for us to generate higher revenue. And it says 75% of purchases are on credit, and purchase equal to 60% cost of sales. So this is normally used when you are calculating your inventory days, and this is for the next coming lesson. Actually, everything from this point, it's actually relating to our next lesson, which is going to be talking about the liquidity ratio. So to say that 75% of whatever we buy from our supplier, we buy 75% of it on credit, and then 60% purchases equal to 60% of cost of sales. So our cost of sales, so if you want to know how much you purchased, it's going to say cost of sales multiplied by 60% is going to equal to purchases. And 60% of that amount, or whatever amount we get after calculating the 60%, 75% of it is on credit, 25% it's cash basis. So to calculate the first few ratios, sorry about this, guys. To calculate the first few ratio that we talked about, we're trying to calculate the gross profit margin ratio. The gross profit does not require us to go outside of the income statement. The gross profit ratio for 2002 to 2004, or 2.4, it's going to be 160 divided by 490 multiplied by 100. So let me take a look at if I can find a calculator over here. So gross profit for 2002 will be 164 divided by 490 multiplied by 100. This will give us 33.47%, rounding off to the nearest two decimals. So that is 33.47%. So this just means that the profit realized by this company after contribution of cost of sales alone is 33.47%. So if I was to round this off to the nearest percentage, I would say 33%. So this means that cost of sales account to 67% of sales. So that's how much cost of sales account for. 67% of sales is made out of cost of sales, and therefore the profit that is realized after that is only 33%. So by just looking at the figure, those two figures, you might think that the profit in 2002 is bigger than the profit in 2003, but when you calculate the ratios, it might actually tell you a different story. But here you can see that the prices are ranging from the same, are almost the same, so this means that it is actually declining. So let's do the one for 2.3. 2.3 will be 133 divided by 453 multiplied by 100. Still under gross profit, this will be 29.35. Rounding off this to the nearest percentage, I will say 29%. This means that the profit realized after contribution by cost of sales is actually 29%. Cost of sales account to 71%, if we to round this off to the nearest percent. So you will see that this company is now incurring a higher production cost. I'm not sure if it's production cost, but since we are actually purchasing, we're in a publishing environment, our resources that we use to publish our books it's actually are more expensive, are getting more expensive, and therefore lesser profit will actually be generated. So meaning that we're spending more on acquiring resources to publish the books, and therefore our selling price remains constant and does not get to change much. So that's why we are then realizing lesser gross profit. And if you continue to check in 2.4, we made a gross profit of 110 divided by total sales of 390, multiplying this by 100. We then only generate a profit of 28, gross profit margin of 28%. You'll notice that it is still declining. So meaning that the prices of material is still increasing, and therefore we are suffering from what? We are suffering from a higher resource cost or higher material cost or inventory cost. So our inventory cost is actually high, meaning that our supplier is supplying us at a very high fee. So this means that therefore our profit margin are actually less. are becoming lesser and lesser all the time. Because if we increase our selling price, customer might actually run away from us. And when they run away, we get to lose more customers, and then we still incurred a higher cost for acquiring our inventory. So our gross profit will still continue to decline. So this is the explanation that you can give behind this scenario. So this one, I think there is a solution over here. As you can see, it says that the decline in this ratio should be a concern for the business. The business stipulates a 50% markup on cost. So if it's a 50% markup on cost, we expect to generate a gross profit of at least somewhere around 50%, or a gross profit as a percentage of 33%. Okay, the profit is 33%. That's what we are supposed to make, which is 50 out of 150. Because we are saying that if a product costs us 100 Rand to make, we're going to add 50 Rand and sell it at 150. So meaning that our gross profit should be 50 divided by 150. So we should be making a gross profit of 33%. But if you take a look, only in 2.2 we managed to make that gross profit. But 2.3, 2.4, our gross profit went down. So it means that even though with this markup, it's either our selling price have remained constant, whereas our production or our cost of sales have been increasing. So I do not know, maybe we are losing more stock. So another comment might actually be losing stock. If you lose stock, you remember shrinkage, the one we covered on our last week, shrinkage. If you are losing stock, when you lose the stock, you include it in the cost of sales and your sales is not growing. So that could also be the cause. So here it says that during 2.2, the target was achieved successfully. However, in 2.3, especially 2.4, there was a significant drop in this percentage. The reason for this decline could be stolen, lost, or obsolete inventory, clearance sales, etc. So this could be the cause, because now we are still offering the same markup of 50%. So which means that either we are now buying expensive from our supplier, and then we drop something, we drop our selling price or some stuff like those, because that's the only explanation that could lead to us not achieving 33% gross profit. Because now we've achieved 29, after that 28. So there is decline. So meaning that when stock is being stolen, we increase our cost of sales by that stock that is being stolen, because we can no longer recover it. We need to remove it from inventory to cost of sales. And therefore, our cost of sales increase while our sales remain the same, and therefore we then have a lesser gross profit margin. So if a constant markup of 50% on cost will maintain, however, the cost of sales figure for 2.3 and 2.4 seems to have been significantly loaded with unexpected contingency. So meaning that it have declined as well. So meaning that there might be a chance that the cost might not just only be the 50% markup. We might have reduced our markup, which can also cause this decline in profitability. So we do not know yet. So those are the things that can cause the decline in gross profit. So any questions so far, guys? Any questions so far? All right, thank you for the confirmation. So this then brings us to, what is our second one? Net profit. So net profit also not requires us to go outside of the income statement. We use the income statement as well. So we come to our net profit over here, which is 94,000 for 2.2, and then we compare it to the sales of 490. So I just need the calculator. So here we're going to have 94,000 divided by 490 multiplied by 100. This will give us 19.18%. So this is the net profit this company realized after all the expenses have been taken into consideration. And then in 2003, the net profit is 56,000, and then sales it's 453,000. Multiply this by 100, which is therefore gives us 12.36. There is a decline in net profit. So with this decline, it only means one thing. We are incurring more operating expenses compared to the previous year. So this means that our operating expenses have increased. Even without looking at these operating expenses, by just only using the net profit, it can tell you that your operating profit, your operating expenses have increased. That's why there is a decline in your profitability. So let's take a look at 2.4. 2.4 net profit is 32,000 divided by 390. Multiplied by 100, giving us 8.2. So it continued to further decline. So meaning that the operating expenses further increases compared to the previous years, leading to a higher decline in net profit. So if the company wants to do something, they will actually have to try to reduce their operating expenses. So meaning that they can be able to achieve a higher net profit margin. So on this one, it says that there has been a continued decrease in profitability since 2.2, as you can see, from 19 to 12% to 8.21. It seems if the decrease in net profit margin was due to the factor of causing the decline in gross profit, but it is not the case in most cases. There can be a decline in gross profit and an increase in net profit because of one reason. The operating expenses are increasing. If they are not increasing, therefore we expect the net profit to only decline if the gross profit declines. But if the operating expenses continue to, let's say operating expenses become less, therefore we expect this company to be profitable even if there is a decline in gross profit. So here it says that the rise in operating expenses was not exorbitant and could be argued that the mere inflationary pressure caused the increase. So which means that inflation could be the cause of increase in operating expenses, but that's something that could not be fully justified. But what we can just say is that with the increase of operating expenses, we expect the net profit to decline. And already there was already a decline in gross profit margin, so this also add on top of the decline in net profit. So the last one, which is a return on average owner's equity, because the word average owner's equity, what it means is to say that on the average owner's equity for 2.2, when we calculate the one for 2.2, we're going to take the one for 2.1 and 2.2 and then divide them by 2 and calculate the average. So let's make an example of this one. So the return on average owner's equity requires us to look into two financial statements because we need net profit. It's going to be statement of comprehensive income or income statement. And then because we also need shareholders' equity or owner's equity, this can only be found in the statement of financial position. So we come here, owner's equity here in 2.2 and 2.1, it's 127 and 161. So using our calculator, we're going to say 161 for 2.2 plus 127 for 2.1. This is 288,000. This divided by 2 gives us 144,000. So the average owner's equity for 2002 is 144. For 2003 will actually be 209 plus 161. So that will be for 2003. And the total will be 370 divided by 2, giving you 185. So that's how you calculate the average owner's equity. So let's start with 2.2. We said the average is 144. So meaning that here we are going to say the net profit for 2.2. Oh, it looks like I've moved a lot. The net profit for 2.2 is 94,000. 24,000 divided by the average. Average is 161 plus 127 divided by 2, giving us 144. Multiply this by 100. So meaning that the average return on owner's equity is 65%. So these guys are enjoying 65% return over their investment. Even if the company's profit is declining, that's how much they are actually enjoying. So that is how much profit these guys are enjoying. And let's take a look at 2.2. So 2.2, we said that it's 209 plus 161, giving us 370 divided by 2, which is 185. So this is the average owner's equity. And let's also take a look at the profit they make. Profit they make was 56,000. So it's 56,000 net profit divided by 185, which is the average owner's equity, multiplied by 100. So there is a huge decline from 60% to 30% return of their investment capital. So it means that now their assets are not being, or their capital is not being used efficiently. So meaning that their investment is not well managed, because now instead of them from 60%, now they are now earning a return of 30% over their investment. So this means that we also expect this to drop as we continue. So let's just go take a look at the already calculated figures. So here we've got 60%, 2.2, 2.3 we've got 30.27, 2.4 we've got 13.28%. So the return on equity have decreased significantly in a way that it's much bad. So this means that the investor might actually pull off. They might sell the company's shares and pull off, because now this company is actually declining, which means sooner or later they are going to start suffering losses. So this means that before they suffer losses, they might actually sell their assets, which means they might sell their shares and therefore run away from the company. And this will be the downfall. If all investors are selling at the same time, it means that it will also affect the company's operation and the image. So meaning that no investor will want to invest into the company, meaning that if we need funding to continue operating and fund our future projects, where are we going to get the funding if investors are already pulling off? So no one will want to come to our rescue and rescue us. So this means that as a company, we need to find a way to improve our net profit margin. So to improve our net profit margin, we might start up there with cost of sales, because that's where the decline is already starting from the gross profit. And then from that point, we then try to decrease our operating expenses. Once we increase our margin, we know that net profit will increase, and therefore we expect the return on owner's equity to increase as well. So which means here the return on average owner's equity is declining, and investors might actually pull off from this. So this is everything that we have to cover in terms of today's lesson. So if you have got any question over these three ratios, these are the ratios that you are going to be assessed on in the assessment. You need to be able to understand them, explain what the ratio means, explain what your final calculation actually means. When you explain, I can see that here there is a decline. So I will give you a mark to mention that there is a decline, but what is causing the decline? Then that will be another mark. Do not tell me that there is a decline and the decline is 30%. That I can see. If I am trying to, I can be able to read that by just looking at these figures. The investor is to explain to me, why do you think this is decreasing? I want you to brainstorm and think hard and say, if this is a publishing company or this is a media company and this is happening, what could be the most possible explanation for this to actually happen? So I want you to think of something that is practical, not something that is fictional but practical, since we are living in a practical world. So any question, guys? I think this brings us to the end of our of today's lesson, which means that we'll still be a chapter behind until we complete lesson number 20, which is financial, which is part B, which is talking about liquidity ratio. I think we'll do this on class next week. So any questions? Tulefelo, Manda, Amo, do you have guys any questions? All right, in absence of question, please guys, there is an activity that you have to do. Okay, the activity, I think you'll get it after we do part B, because it have to be inclusive of all of these. I think this is the activity 4H. This activity 4H is you are supposed to do activity 4H. Under 4H, you will notice they've given you industry average. They've given you the performance for this company from 2005 to 2006. You are supposed to do 2007 yourself. And I will also want you to comment and tell me what is this. So this activity, we'll do it in class, even though we'll be behind by some of our lesson. I do know that I will find a spot where we'll be able to cover any remaining topic before you write your assessment, because I want you guys to understand this, and I don't want you to fail your summative. I want to make sure that you understand the concept. Even if you go out there anywhere and someone asks you, why are you investing here in this company? You can be able to tell them, no, I've done my ratio analysis and this is what they're telling me. And looking at the industry, there's still possibility of growth. Looking at what the economists are actually saying about this industry, I've used the following ratios. So I want you to be able to do this. And if someone asks you to say, I want to partner with you, I want you to become my partner. I've already opened the business. This is how the business is doing. First, assess this person's gross profit, net profit, how much is he getting as a return over his project. And then we'll also perform this other liquidity test. Liquidity test as to assess if this company will actually fail in future because it have got too much debt. So those are some of the things that you assess before you become a partner with someone in his own business that is already operating. So those are the things that you need to assess. And then if everything is good, you can say, okay, it's fine. I can invest into your business. We can become partners. Then if it is worse, just drop it and say, unfortunately, I cannot invest because your company seems to be struggling at this stage and time. And even if I try to put in my money, looking at what you are actually currently facing as the challenges, this might actually even be worse. It might actually get worse and I might actually lose all my investment. Because as a shareholder, you get to lose all the money. But as a debt holder, you don't get to lose all of your money, because if the company fails, you can tell the person to say that I can just borrow you the money that you need. If the company fails, whatever assets you used to buy for your company, I'll come and collect them as collateral at the end. So that's the benefit of being a debt holder of a company. So you can invest as a debt holder and give the person a debt. If you don't want to invest as a shareholder, you still benefit because the person will still give you interest over your investment, and they're still guaranteed to pay you back, or they're still required to pay back their capital. So those are the things that you're going to assess. So since there are no questions, guys, you will enjoy the rest of your weekend. We'll meet next week, Tuesday, and please stay safe over the weekend.